Hi, welcome to Bond Bytes, a daily bond market highlights from INR bonds. And today is RBI's policy special Bond Bytes, where the RBI raised rates, but not enough. And will this be enough to prevent the markets from falling further and sending more worries to the investors? Before that, do not forget to attend my Spaces today at 8 p.m., where I'm talking about bonds and its impact on equities, the Nifty and Sensex. And also do not forget to register for our webinar on the overlook for debt markets and what should fixed income investors do. This is on Friday at 4 p.m. The registration links and the Twitter handles are given in the description below. Look forward to seeing you both on Spaces and on the webinar. Coming back to RBI policy, the RBI governor, Mr. Shaktikanta Das, did say that the RBI is concerned on inflation as it hiked inflation forecast to well over 6.5% for the full year, and also raised interest rates by 0.5% or 50 basis points. So the market was expecting 75 basis points rate hike, thinking that the RBI will be worried about all the global inflation and all the things that is happening on the external front as well. But RBI is choosing to go slow. And this, to some extent, cheered markets today. The 10-year Gsec yield fell from 7.56% to below 7.45% as there was short covering. The Sensex Nifty too fell initially and then rose, while the rupee ended up, while falling initially, was higher against the dollar just as we speak. But having said that, the question is that what's going to happen to investors going forward with so much of negatives in the market? RBI is going to hike rates. It's an inevitable situation, and so whether they do it 50 basis points today and another 25 basis points for the next four meetings or something like that. But if something comes up and takes the rupee down to 80 plus to the dollar, then you have a big problem. And RBI might certainly wake up and say, like they did in May, that they'll have to increase rates much faster. And they have done it earlier in 2013. Suddenly they came and raised the rates very sharply. Money in the system is also going to come down as there are capital outflows, and the inflation is continued to stay high. Government borrowing is going to be exceptionally high, given all the subsidies they're taking on behalf of the cut in fuel prices, which is supposed to bring down inflation, but in another manner is actually taking up government borrowing, which again is hurting the investors. So very difficult times for investors. Best place for investors, especially in the fixed income, is INR bonds, where you get all the information, analysis, and the best bonds to invest in through our Quick Invest app. Quick Invest by INR Bonds app, available for downloads on iOS and Android, where we give you the best bonds to invest in, whether you're an investor or a financial advisor looking to put bonds in their client's portfolio in times of inflation and high risk aversion. The curated list of bonds in the Quick Invest app gives you all the information and also the risk that you need to know while investing in these bonds. And all you need to do is just download the app, choose the bond, and then the bonds are in your demat account by the end of the day. Thank you very much. And do not forget to attend our spaces and our webinar. The links are in the description below.
It was a tough journey going from an intern to a senior professional. Now, to protect my savings against high inflation and grow my wealth, I invest in bonds with INR Bonds. Download the INR Bonds app to save better.